Let's face it, we all want to do well and get the best results with our investments. We wish we could have the Midas touch where everything we touch turns to gold, but the reality of it is that most of us don't do all that well. Some may even think that they aren't good enough or just aren't cut out for this. While a lot of people may feel like they aren't getting much out of investing, there are those who have managed to successfully navigate their way to the top and gain much success. So this begs the question, what are they doing that puts them ahead of everyone else, and what principles can you apply in order to replicate that? Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. When it comes to the topic of the best investors of all time, one of the names that comes up is that of Peter Lynch. If you are new to this channel, then you probably know about him. You most likely know that during his 13 years as the manager of the Fidelity Magellan Fund between 1977 and 1990, he averaged a return of 29.2%, which is an astonishingly high number that is very tough to beat. This makes him one of the 1% who achieve greatness and is therefore a good subject for us to study, as one can learn a lot from him.
It bothers me that people are very dangerous when they invest. This word play the market, that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, and find out this company has lots of debt, no cash, they're in trouble. You should know it. So a little bit of research. People are careful they buy a refrigerator, careful they take a vacation, and they'll put $5,000, $10,000 some stock to hear on the bus or the party. That's dangerous.
The first step in getting ahead is being careful and risk averse. If you're going to be successful at investing, it is not going to come without you putting in the work. As Peter Lynch says, do your research just as you would if you were buying a refrigerator or going on vacation. You'd want to get the best value for your money, right? The same mindset should then apply when it comes to your investment. A big part of this is to avoid seeking out the hottest and trendiest stocks and wanting to invest in them because of the hype around them. FOMO and YOLO are not good enough reasons for you to risk your hard-earned money on something you just heard about. On that note, here's Peter Lynch to drive that point even further.
Imagine if you were in a mall the last 50 years. You would have seen Gap when it was hot. You would have seen Lemon when it was hot. You would have seen when it was not hot. You would have seen when they were starting, people weren't excited about Gap anymore. Or then you do some research, say, well, gee, there's a lot of limited stores, but we're only at 20. And they can go to 400. So you see a company. I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that there's really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals. So you don't leave the mall, though, and buy that day. You have to do some more work.
Good research is not what you just saw on your favorite finance show or whatever your friend is buying that looks to be doing well. It is not a discovery that you just made when you're walking around in the mall. This can certainly help you identify an opportunity, but you should then go and look at the company's balance sheets and check out how much debt they have and whether or not their stock is trading below or above market value. Once you have all this established, you can then make an informed decision. You don't have to rush to buy. The 1% of investors who are killing it have mastered this skill, and if you're going to ever be like them, then you should work on doing so too.
Well, the way you beat the index is you avoid the stocks to go down. You avoid the steel companies and the oil companies and Sears and Penny and where the companies are deteriorating. I mean, companies are dynamic. Behind every stock, there's a company. These are not lottery tickets. So you're trying to find the companies within the S&P 500 that are doing better. They're going from crappy to semi-crappy to good. That might take a couple of years, or they're going to grow for a long time. And you're trying to avoid the companies that are going south. That's how you beat them. Or you find some companies outside the S&P 500 that are great companies. CarMax was not in the S&P 500. They went up 200-fold. There's a lot of companies that enter, and a lot of their great performances before they go in.
I mentioned earlier on that Peter Lynch managed to beat the markets for 13 years straight. So if anyone knows anything about that, it's him. He gives a very interesting piece of advice. He talks about avoiding certain industries and certain types of companies. All in all, he says to avoid companies that are going down, like JCPenney and Sears. I find it interesting that he mentions companies in the S&P 500 which are doing well, and afterwards mentions other companies outside of it that are also doing well. The companies that are in the S&P 500 are pretty much the best 500 companies in the United States, and some of them the best in the world too. So the chances of them doing well are quite high. That being said, whether in or out of the S&P 500, the way you would know if they are good companies to buy is by doing your research. Remember that behind every stock there's a company. These are not lottery tickets. Companies are dynamic, so going by the performance of the stock alone is a gamble. When it comes to stock of a company, as soon as something negative happens, like earnings going down significantly, the price will most likely drop due to investor sentiment. So if you're only looking at the stock and its performance, what do you do in such a situation? This kind of thinking will lead you to become just like the 99% and not the 1%. I think it's appropriate to mention that along with looking at the companies within or without the S&P 500, there's always the option of investing in the index itself. If you'd like to learn more about how to go about doing so, check out the video linked in the description of this video.
Well, obviously, the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Whenever the market went down, I went down more. But over the long term, the upside is more than the downside. So you're going to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
There are 2 things that we can learn from Peter Lynch here. First, don't try and predict the markets. And second, don't invest money that you'll need in the short term. In other words, invest for the long term. These 2 lessons go well together because the 99% will try and predict the markets and then invest some money, or should I say gamble their money, in the hope of getting a good return as soon as possible. This is a risky approach as the market could go against your prediction and you'd be left with much regret. Similarly, investing for the short term in the stock market is not a good idea since the market is constantly changing. But over long stretches of time, if you stay consistent, then you will reap the rewards as the market tends to trend up when looking at it from a long-term perspective. The art of patience is one that you have to learn if you are to do better than average. If you want to be like the 1%, and being like them means becoming one of them. Earlier on, we heard Peter Lynch talk about industries to avoid. So are there any that he recommends?
No, I saw the textile industry deteriorate. I was recommending all the stocks on the way down. I saw the shoe industry go away. Industries can go from terrific to terrible. There's a great expression in the textile industry that helped me a lot. It's always darkest before pitch black. Just when you think things are terrible, they get terrible squared. I mean, so just because industries are getting bad, that's not a reason to invest. Wait for things to get better. Because again, somebody might be involved in steel. They might be involved in coal. They might be involved in iron ore. They might be involved in plastics. They'll see it aluminum pick up before I do. So that's a cyclical turnaround. That might last 2 or 3 years. You might see it way before Wall Street sees it.
So Peter Lynch is pretty much saying that any industry can get affected, and I'm sure you can remember how COVID definitely showed us the reality of those words. Essentially, we must always be on the lookout for good opportunities and be ready to seize upon them. We need to be able to identify opportunities in our own industries where we operate and use that information to get ahead of the curve so that by the time everyone else catches on, you're already ahead. This is something that the big investors do quite a lot, especially with the fact that there are people who like to shadow what they do. By so doing, they have to wait for a filing called the 13F, which only comes out 45 days after the end of the quarter. By then, it's kind of old news and the big investor is already miles ahead. So Peter Lynch is famous for his investments, and therefore whenever he speaks, people listen, even the very greats who are part of the 1% that's ahead. Here he is telling a story about it with an important principle, of course.
In 1989, I'm at home, and the phone rings, and I thought it was one of my friends, but one of my daughters, I think it was 6-year-old Annie, picked up and said, "See, there's a Mr. Buffett online?" I said, "This got to be a joke." So I pick it up, and this Warren Buffett, we're from Omaha, Nebraska. You know, I read your book. My annual report's due in 2 weeks. Can I use a line? He said that all in about 7 seconds. And I said, "That's great. I'd love to do it. What's the line?" He said, "I love this. It's been waiting to do this. When you sell your great companies and add to the losers, it's like water in the weeds and cutting the flowers." He said, "I want to put it in." He said, "If you ever come to Nebraska, you don't call me. Your name will be mud all over Nebraska."
So did he call him?
Oh, yeah. I've said several times we play bridge together. we've had several meetings. Great guy.
So even Warren Buffett recognizes the greatness of Peter Lynch and the things that he has to say. The line that he asked to use is one that we can learn from. There exists in the minds of many the fear of things going wrong, even when things are going right. Sometimes people panic and make all kinds of questionable decisions. Selling stocks that are in profit for the mere fact that they are in profit is not a good idea and is compared to cutting down the flowers, and using the profits to buy up stocks that aren't growing is compared to watering the weeds. You don't need to be a gardener to know that such is a bad idea. That's what the 99% tend to do because it is easy to do. They overthink and they overcomplicate things. In case you're wondering what book it was that Warren Buffett read from Peter Lynch, it is titled One Up on Wall Street and is a must-read for investors looking to get ahead on their investing journey. These are some of the things that you can do in order to get ahead and to be the best investor that you can be. To sum them up, they are: be careful and risk-averse, do your research before buying, look for good companies to buy, don't predict the market, invest for the long term, take advantage of investments within your industry, and understand when to sell. With these principles in place, you can start growing in leaps and bounds and not have to settle for being average. I hope that this video has been inspiring and that you'll put much consideration into these points and how you can apply them so they can start taking effect in your life. Were you surprised by any of these points? Which one was your favorite? Let me know in the comments below. If you found value in this video, then show some appreciation by leaving a like and sharing it with a friend. Subscribe to the channel if you haven't already done so, and click on the notification bell so you stay informed and inspired through the videos I post here. Thanks for watching. Hope to see you on the next video. But until then, stay invested.